to the part two of our essential webinar series on securing your lendings.
After signing those documents, the next role is of the registration of those documents. Some of the documents, some of the securities, when we extend loan, they need to be registered so that there will be perfection of charge. When perfection of the charge is there, then only we will be able to ensure that is recover the amount. So this is a process, that is perfection of charge borrower, and the borrower declares that I am a proprietorship concern, we are the partnerships, etc. Okay, second aspect is, if second aspect, whenever the second document is the demand type, when we extend different types of loan, whenever the loans are of the demand type, that is, whenever the banker demands the customer should pay back that particular money, this type of facilities, they are in this in these type of document. The basic document definitely is a DP note and an agreement that he will repay that particular amount. Then repayment, if the loan is such that he will be repaying the loan in the installments, so facility is installment repayment. Then we take the term loan agreement. Similarly, for bills, whenever we extend loans against the bills, like the facilities like bill purchase, bill discounted, supply bills, etc., we take a basic document as in respect of bill purchase, bill discounting. Similarly, in respect of non-fund based facilities like a bank guarantee and letter of credit or acceptances, we always take a document which is related with the bank guarantee on those. So master facility agreement, we take this agreement as a basic agreement. Along with this, there is another agreement which is creating the charge over the security, and that agreements, those agreements are deed of hypothecation, deed of mortgage, a deed of pledge, or a deed of lien. So this document creates a it creates a over that particular security. Lender can realize these securities or assets in case of default after forming certain formalities. For example, under surface we have to give notice, and then we can go ahead, take possession, and sell the goods, etc. In most of the cases, the ownership of the assets is not transferred in favor of the bank. Remember, in respect of our transactions, whenever we extend loans, we obtain different documents. They are nothing but different contracts. Under these contracts, the ownership remains with the borrower. Only thing is that the we get, that is a charge only, is that is one of the rights are transferred in favor of the bank. In some of the cases, the goods are in either in our possession. In some of the cases, the goods are in the possession. Now lien is a charge, as you are aware, to hold the security till the repayment of the loan. Then government securities, different government securities are there. Again, the charge is lien, and we take a letter of lien. Similarly, shares and debentures, the charge is lien and transfer, and we take a letter of lien from them, and bailment of goods, and the banker holds that particular goods till the repayment of the loan. And the relevant agreement is agreement of pledge. Agreement of pledge in respect of we obtain an agreement of pledge. Suppose we have sanctioned a CC loan, cash credit loan, to a sugar factory for their daily needs. Then the documents it will be taken will be like this. First, being a sugar factory, if it's a limited company, or if it may be a society, so in respect of that, first documents will be obtained, and an agreement of pledge will be there. These will be the documents, a set of documents. Similarly, if the commodities are goods or book dates, means they are floating commodity, they are the current assets, then agreement of hypothecation is obtained. Now, agreement of hypothecation, or in respect of hypothecation, you are aware the goods are in the hands of the borrower, in the hands, and if they are in the form the commodities, those goods in this thing, it's a type of possession. Agreement of pledge or hypothecation, we obtain these type of agreements in respect of that. Okay, immovable property. Now, immovable property, we obtain either a registered mortgage, and in respect of and through a deed of mortgage, bank can go ahead and he can possess this particular property and sell that property after completing certain formalities. This particularly is a transfer of specific interest in a immovable property. That specific specific property and transfer of interest, and through this is done through a once this is there in respect of mortgage deed. Deed means a legal document under which we get the benefit, that is, we get a right to sell the property after completing certain formalities, and this right is possessed by us and kept with us and maintained with us. Then immovable property, we can also create we can also create what is known as mortgage by deposit of title deeds. Means commonly it is known as equitable mortgage, wherein the borrower or the, I will say, the property holder, he comes to the bank. Either he may be borrower, intention is very clear, in order to create a charge over them. For what purpose? For the purpose of repayment of the loan. Like that, things are there, and therefore, in respect of mortgage, remember, we create, we that is, as a banker, we write it, and that writing is called as memorandum or recital of deposit of title deeds. In short, like this, we something like this we write. Mr. XYZ called on us on such and such date and deposited his title deeds. Okay, the title deeds details are given in order to secure the loan. The loan details are there. Then in respect of his the property details will be there. All these things, and this particular memorandum will be signed by the branch manager. We have that is you have handed over these deal with an intention to create the charge. Like that, the letter will be there. This letter will be acting as a witness of, I will say, witness of that particular effect, that is witness in respect of mortgage. So that will be there. In respect of supply bills, whenever the goods are supplied to a government department, at his place, it will be registered. If it is assignment, hypothecation need not be registered with him. Then movable fixed assets, the assets can be immovable. If they are immovable fixed assets, we create the charge of equitable mortgage, that is mortgage but or registered mortgage. Of course, my dear friend, there are different types of mortgages. Person as a borrower, so one firm to another firm, no such type of guarantees are not permitted unless and until it is very clearly written in the deed. Say like this, CHG 8, CHG 4, this has to be signed by both banker and the customer, and this has to be filed like that. Enunciates the legitimacy of ownership, who is the owner, and ensures that the property is free from disputes and encumbrances. So, clear title, all these things are certified by our advocate. Then, title verification. Due diligence is conducted to verify the legitimacy of the ownership before transaction. So, before transaction, all these things are to be there in the title report. Legal documentation. Then ownership is established through a registered sale deed. Now, how the advocate has conducted that applicant or guarantor is the title holder. That is how he has derived the title. So the chain of the documents, he has to spell out the chain of the document. Remember, this is a very important aspect whenever accepting that security as a mortgage. Then verification, which one is the original document of ownership. Then he will also say that they should be identical, particularly the loan application, the title deeds or such this thing, agreement of sale, valuation certificate, sanction, building map, plan, estimate, etc. They should be in cohesion. Estimate, title deeds, agreement, all these, they should be matching with each other in valuations and in the legal search report. Branch managers must inspect the property, security, and convinced about the valuation. He should be convinced about the valuation. So when valuations, etc., are complete, now the next step comes. It is about the stamp duty. Now let us understand what is stamp duty. Acts decide the stamp duties. There are two acts I have already told. First is Indian Stamp Act 1958. They are uniform across India, all states, and generally the stamps are these. Which are the documents which are coming under this? One is the demand promissory note, the usance promissory note, the bills of exchange, usance bills of exchange. Then Indian postal stamp. You are knowing that it is for sending the post from one place to another place. Then non-judicial stamp paper, first is the revenue stamp on certain documents. So on certain documents, revenue stamp has to be adhered. So this is the first aspect. The stamps, revenue stamps, they may be from the 10 paisa. How much stamp duty is to be adhered to a particular document, then you can take that document to him, to the collector who is at district place, and get a letter from him, that letter is called as adjudicating authorities certificate. This certificate enables you and adhere that certificate with the stamp, so that there will not be any problem henceforth. Adjudication of stamps and what is the value of asset, both of them, they are important. Now stamp duty, stamp act, some of the important documents covered under the Indian Stamp Act I already told you, and this is the stamp duty which is to be there. So again I will be saying, bill of lading, bill of exchange, bill of lading, then debentures, letter. If it exceeds 500, duty is 120, and if you take for every additional 1000 rupees, 1 rupees 26 debtor, these are the stamps required in respect of usance promissory note and usance bills of exchange in respect as per. Now, other documents carry a stamp duty as per Stamp Act. It requires full signature of the executants. Executants means the signatories. Okay. Now, in respect of execution of documents, signing is an important milestone in the financial transaction. Important aspect is signing. Okay. Then it is a stage when the parties execute the agreed version of the documents. Now, whatever documents are there, they have agreed. In several documents, we need not be signed by us, because they are called as standard form contracts, means as a partnership firm and an individuals, like that two signatures will be taken by us in respect of that. If it's a limited company, always everything, they work as per the board resolution. One thing, for on application, on the sanction letter, on, I will say, loan, different loan document, everywhere there will be electronic signature, or what is commonly known as digital signature must be placed on those. Okay, it streamlines the efficiency, and it increases the security. Now any ESL, then stamping will be there. Agreements, there will be standard agreements, they are there according to the and the signatures with the e-stamp and electronic signatures. This will be always e-stamp and electronic signature also will be there. This is how the methodology of signing is there. RBI guidelines on digital lending. It requires lenders to send digital signed loan documents to borrower and guarantors. Remember, ensuring obtention. Now in respect of these agreements, when they are that is when digitally signed through the platform, this particularly, I will say, this utility, when you are using, it should be signed digitally by the banker and the borrower, or the banker and the guarantors also, it should be signed, and then only the signature of both, and then it should be shared with all of them. This is the methodology of how it is done. The platform of digital signature authorizes. There are several authorities who handle digital documents. Now, who handles digital documents? One is controller certifying authorities, and the signature will be digital, and this will go to the beneficiary's bank, who in turn may give a printed copy if required to the beneficiary. Efficient processing and fraud prevention, these are the two application process. The process of end-to-end digital issue of bank guarantee, online application for bank guarantee, issue standard format. The most important part of our discussion is here. We have already seen what is the charge. It means the interest or lien created on the property, asset, or borrower as a security, and includes a mortgage. It includes the mortgage too. Okay. Then the if it is an immovable property like land, building, plant, machinery, furniture, fixture, trees, etc., the mortgage, if we have created a registered mortgage, then it has to be registered with the relevant sub registrar's office. So again I will say, the document which is executed may be in the bank, it may be equitable mortgage or registered mortgage, whatever it may be. We may be having a charge or pledge or hypothecation or an assignment or a deed in the books of the company. the books of the company, that particular book is called as CHG 7. This is called Register of Charges. So registration in respect of companies will be at two places. One definitely will be with the registrar of the companies. Of course, if it's a mortgage, it will be first registered with the registrar of the sub registry office. It has to be done. Similarly, along with that, register of the company, we are having, if we are having a mortgage charge, if we are having a hypothecation charge on the crops, etc., if we are having a lien charge over the produce, or we are having a plate charge like warehousing, all these charges also need to be registered with the farmers society to whom we are given the charge, along with sub registrar of mortgages. And if it's a warehouse, we have to the warehouse keeper also. This particularly passing of the benefits should be registered with the concerned authorities who have issued this thing. So LIC has issued in the books of LIC. If it is in respect of assignment is in respect of the book dates definitely will be in respect of the borrower's client. So borrowers, buyers will be there in their books. It has to be registered. This is the in respect of assignment. Okay, in respect of hypothecation, this charge need not be registered. They need not be registered. Even here also, in respect of book dates, we may register it afterwards also. Okay, it may require, we may register it, we may not register it, but still our charge will be always there. So mortgage by deposit of title deeds, then along with other documents whatever are required, then the charge which are to be registered are hypothecation, pledge, lien, registered mortgage, etc. All those charge needs to be run. It is type of public notice we have already seen it to their sub company. Then in, and they are giving assets. They are also giving assets. So principal companies assets are there. Then it has to be registered. If no assets are given, there is no need, and hence enhanced risk assessment must be, that is we must register all the charges first. I will say along with the ROC, here registration is important. Through registration of security of interest in the properties to create a transparent lending process. Now this, remember this thing, uh, ensure better loan underwriting. This is important, very important. Unless and until, mortgages and other assets they are registered under the SARSA, they will not be available if not registered on the SARSA. Immovable property, all types of mortgages, whatever mortgage type is there, it has to be registered. Hypothecation of plant, machinery, equipment, stock, debtors, everything, whatever the hypothecated is there, hypothecation charge is to be. Then intangible assets, yes, being know-how, patents, copyright, trademarks, etc. We will go through this limitation act fast. It is not very in details. Limitation, remember, in respect of documents, it is stated that if it is within the 3 years from the date of execution. Okay, this is the 3 years from date of execution. Remember this thing. Okay, if a document is signed by more than one person, if three persons are there, okay, then the third person, when he signs, from that time it begins. Then agreements are executed. Now different agreements are there. If the agreement are of the demand type, the limitation period again is 3 years from the date of documentation. So date of execution or date of documentation, from that date. If the agreement is signed by, from the date of debit balance to 3 years will be this thing. Now in respect of term loan agreement, here I have given an example. Please concentrate here. If a term loan agreement is there on, it is executed on 4/7/24, and repayment is in 60 EMI including moratorium of 6 months. Suppose the first installment therefore due is 4/1/25, second will be due on 4/2/26. Like that, different due dates are there. So this installment, for this installment will be validity will be 3 years from this, that is 4/1/28. For this it will be 4/2/29. Like that, for each installment validity will be different in agreements. But first and foremost is before the expiry of the prescribed limitation period. So whatever prescribed limitation period is there, that 3 years, etc., we have seen. Before that, if you do anything of this, then limitation can be extended. First is by signing the acknowledgement of debt by borrower and guarantors and a link letter. Then, if you take a link letter, or a match mandated is there, and if this match mandate or ECS mandate is returned, in that case also, again I will say, from the date of return, it will be treated as the acknowledgement of debt by the customer, and 3 years will be running from that date. Then simple aspect is, again, take a fresh set of documents when the limitation period is ongoing. So fresh document again extends the limitation. So limitation can be extended by, and from that day it is valid. And fresh set of documents before the due date. Invariably obtain fresh set. When fresh set is to be obtained, remember, when there is change in credit facilities. Suppose you have sanctioned credit facility of 10 lakhs. Now you are changing. Then in that major changes are there. Better is always take a fresh set of documents. Changes in the consortia, in the constitution. If borrower